This reporting period capped 2019 as a positive year for investors, demonstrated by the Investment Association Global Sector returning 21.92% during the calendar year. Sadly, the mood turned sour in January as concerns about a possible US-Iran war surfaced briefly before the risk of a coronavirus pandemic gripped market sentiment, driving equity markets lower, especially in China. Market volatility has continued since the period end, with a sharp rebound across all the main sectors, reversing January losses. UK stocks and sterling rose during the latter stages of 2019, as the Brexit stalemate was eventually broken by a December election. The electorate returned the Conservatives to office with a significant majority, providing Prime Minister Boris Johnson a clear mandate to get Brexit done. We expect the Brexit negotiations to remain fraught, causing further bouts of market anxiety, but that a compromise deal will ultimately be agreed, perhaps as an initial Phase 1 deal with a further extension period to agree other, more complex areas. Outside of the UK, the mood was lifted by a truce in the US-China trade wars. A pact signed in January reduced tariffs and saw China pledge to increase its US imports. Although there is scope for further trade tension in the future, it is unlikely to happen before the US election, as Trump is expected to position the pact as a victory for his America First policy. The UK election saw all major parties promising big spending plans, following a decade of austerity since the credit crisis. Politicians are acutely aware of the need to win votes if they want to be in government. We expect to see this trend across other major economies, and the upcoming US election will test this hypothesis. If both US parties do try to win votes with spending promises, this will create additional and more direct fiscal stimulus. As we moved into 2020, the stage appeared set for a year of positive returns. Then, investors were reminded suddenly of unidentifiable risks in the form of a deadly new virus emerging from China in late December. The news initially caused a panic in markets exacerbated by the closure of many Asian markets over the Chinese New Year. Losses seem to have now recovered, and the initial panic is abating as further details have emerged. Although the coronavirus appears to be more infectious, its fatality rate is around 2%, well below the 10% of a previous epidemic, SARS. A sharp quarterly drop in China's economic output was recorded during SARS, but this was recovered in the next 2 quarters as the infection was brought under control. The coordinated global response to coronavirus, along with some warm weather, will ultimately limit its risks to global markets. Despite concerns of a pandemic, one hotspot has been the strong performance of Tesla shares. This stock has often been characterized as a white elephant due to repeatedly missing production targets, making losses and huge capital expenditure. Having traded around $200 to $300 per share for most of the last year, its share price suddenly took off in 2020, representing a near 300% return. The increase followed news of a small but unexpected profit and car production exceeding expectations. Tesla's valuation currently exceeds Ford Motor Company and General Motors combined, and is second only to Toyota. Whether or not Tesla's earnings do ultimately increase to justify its share price, this level of upward volatility seems unusual, reminiscent of the capital misallocation during the 1990s technology bubble. A full PDF commentary of this quarter is available on the Margetts website. Margetts Fund Management, specialising in managing risk-rated multi-manager funds.